in the last week, we talked about the classical theories in financing, because in this chapter, we wanted to know how can we decide our capital structure, or how can we decide where to get the money we need. And basically, what we want to know at this level is whether we should have equity financing or debt financing. And to answer that question, we go back to history, and we learned about the MM theory by Modigliani and Miller, two famous economists, and their findings can be summarized as this. So on the x-axis, we are going to have a leverage represented as the debt to asset ratio. And on the y-axis, we will have a firm value from a shareholder's point of view. And then what the Modigliani and Miller's first research article suggests is that actually, regardless of your capital structure choice, the firm value will be the same for every leverage level. So there is no difference whether you try to have an equity financed firm, or 30% debt financed firm, or 60% debt financed firm, or 100% debt financed firm. So there is no change, so you can just choose whatever you want. So that was the first idea, which is called irrelevant proposition. And the second version of their theory suggests actually you will have an advantage when you rely more on the debt. So actually, as your leverage increases, the firm value increases. And the difference between the previous version is actually they are allowing taxes. So therefore, it means that because when you have debt, and you will no longer pay taxes to the government, because you first deduct the interest expenses from your operating profit, and then you calculate your taxes. So when you have more debt, it means you have more interest expenses, which reduce your tax payments. Therefore, because you don't have to pay to the government, so you will get benefits from having debt. So we often use a pizza model to simply understand this. So before we used that, we had to pay a slice of our pizza to the government. However, because you didn't like to give it a slice of the pizza, so we want to reduce the size of the slice. So it is only possible by paying the interest expenses. So it is like you argue that, hey, I don't have much left over for you, so please do not take it, and then you can have the rest of it. So actually, the firm value that you can enjoy can be increased by having more leverage. And according to this theory, it means that actually it is always better to have more leverage. So you want to have 99.99% of the debt to asset ratio. For example, if your firm is composed of $100, then you want to have, in the optimal choice, you want to have an equity of 1 cent, and the rest of it will be raised by debt financing, $99. And it seems quite unrealistic, considering that in reality, many of the firms do not have such high leverage ratio. Rather, they often choose to have a leverage ratio between 30 to 60. So maybe it suggests that the difference between the theory and the reality suggests that actually there is an advantage in using the debt, but at the same time there is a disadvantage. So the disadvantage, the theory suggests the trade-off theory suggests is that you will have a higher bankruptcy risk. So according to this trade-off theory, the firm value will be given like this. So when your leverage level is very low, you will get similar result as the MM theory suggests. So there is an advantage. Interest tax shield. However, as your leverage increases more and more, you will eventually suffer from another problem. So the firm value starts to decrease, and this difference, the disadvantage, is the bankruptcy cost. So because as your leverage increases, you will face more bankruptcy risk, then eventually the firm value decreases, start to decrease. So therefore, you will find an optimal choice. So to some level, you want to increase your leverage, but after that, you might want to decrease the leverage level. So there could be an optimal choice in your capital structure, and that is what the trade-off theory suggests. And let me further elaborate this by using an example, because we want to understand what this kind of bankruptcy risk is. So I'm giving you an example of this project. So here in this project, I'm doing a game, and I'm participating in a gamble, and I pay $1,000 today, and there is 50% chances for me to win this gamble or to lose this gamble. So if I lose with the 50%, I get only $900, which means actually because I already invested $1,000, I have lost $100 from the gamble. But if I win, I will be able to get more money from the gamble, so I will be able to get $1,400 from the gamble. So here, this panel A shows the gamble results when I try this gamble with my own money, with $1,000. So if I invest $1,000, I get either $900 or $1,400. And because I invested to the gamble with my own money, I received those results fully as my own. So I have a 50 chance of receiving $900, and I have a 50 chance of receiving $1,400 from this gamble. And in that case, because if I invest $1,000 and I remain with $900, I have lost $100. So my return is negative number, minus 10%. But if I win this gamble, and then my return is 40% because I get additional $400 as profit. And by multiplying the probability and the return, I can calculate the probability weighted return. And if I add minus 5% and 20%, I get the expected return of 15%. So this is the statistic way of calculating the average. So let me explain with this on another example. So if I can have one apple with 50% chance and 3 apples with 50%, what is the expectation I can get from this gamble? This is 1 times the probability plus 3 the outcome times the probability. So it is 0.5 plus 1.5, which is 2. So on average, I can get 2 apples from this game. So similarly, I multiply the outcome number with my probability for that case to calculate the expected return. So this is how I obtain this expected return of 15%. I have a chance of losing 10% of my money with 50%, and I have 50% chance of getting 40% of profit. So by combining them, I have an expected return of 15%. And now, in the second case, in panel B, I will repeat this gamble, but without my money, without investing my own money. So I'm going to have only $200, but the rest of the investment, $800, will be debt financed. So I will borrow $800 from a bank, and then I'm going to use the money with my own $200 to participate in this gamble. And then there's no change in the investment outcomes. There's no change in the gamble. So I can have $900 or $1,400 with probability of 50%. And because whatever the outcome is, I have to repay my debt. I have to pay for the interest, which is 800 times 10%, which is $80. At the same time, I have to repay the principal, which is $800. So I have to pay the money to the lender of $880. And in the first outcome, if I have $900 from this gamble, I have to pay $880, and the remainder to me will be only $20. But if I get $1,400 from this gamble, after paying $880, then what remains to me is 1,400 minus 880, so I can get $520. And because in this case I only invested $200 of my money, so 200 over 20 is, if I invest $200 and remains with only $20, I have lost 90% of my money, so my return is minus 90%. But at the same time, if I hopefully if I get $1,400 and then the remainder is 520, so I can create additional $320 out of $200, so my return is 160%. And the average of these returns will be 35%. So the expected return is 35%. So as you can see, by comparing the panel A and panel B, we can find two things. First, it is better to rely on debt financing if we want to increase the expected return. So it was only 15% in the first case, but it is now 35% when we rely on the borrowed money. But at the same time, there is a strong difference between these two cases, because in the first case, actually the result, the outcomes are only I can have minus 10% return or I can have 40% returns. But in the second case, in panel B, I have a more extreme cases. I can have minus 90% returns or I can have 160% returns. So the variation is more large in the panel B. So we can summarize our two findings in this graph. So the first graph here is the panel A. When we do not rely on debt financing, when we use only our own money, and we can have certain level of return, and we can have a certain uncertainty because we don't know what will be our outcomes, but it is only in the narrow areas between this average. But if we increase our leverage, if we borrow from someone else, and maybe on average we can get a higher return. So the average moves to the right side. However, we can have more extreme cases like losing 30% of money or getting more than 100% of my money. So you can have an extreme cases on the both sides. So that means by having leverage, you can have an extreme cases, so you have a risk. So it can go this way, and that will be better for us. However, unfortunately, we can have the opposite outcomes, like losing all of our money, and maybe we are going to bankrupt. So we should aware that by relying on the leverage, we can have a bankruptcy. And then let me apply the same logic to a more to a company in reality, Hasbro. So this is an alternative scenario again. So it didn't happen in reality, but we are just going to think that in early 2017, Hasbro had a chance to acquire a small Chinese manufacturing firm by paying $1.8 billion. And by doing so, if it succeeds, then Hasbro can have an EBIT exceeding $1 billion. And because it needs money, $1.8 billion, to acquire this company, to pay for this, it had two options. First, rely on equity financing. Second, rely on debt financing. So first, it can rely on equity financing, so it can issue and sell new shares of common stock at a price of 90 per share. And the second option, it can raise debt financing by issue and sell 1.8 billion bonds with an interest rate of 5%. So what will be the Hasbro's choice? And EBIT will be $1 billion if the acquisition succeeds. And assume that Hasbro will pay the dividend, the previous dividend decided, which was $2.35 per share. And these are the selected information for the Hasbro. So this column represents the financial information without the acquisition, and the last two columns represent the cases where actually Hasbro acquired the firm, but with stock financing and bond financing. So before this financing and acquisition, it had interest-bearing debt of $1.7 billion, and it had to pay interest expense of this one. And it doesn't change in the stock financing because there is no debt raising. However, in the case of bond financing, it increases because now we have more debt. And furthermore, the shareholders' equity was $1.8 billion before financing, and it could go to $3.6 billion if we issue and sell new shares. But it will remain the same if we do not raise equity financing, but we rely on the bond financing. And then, let me just skip several details, and we can calculate the expected ROE in two choices. So if we have equity financing, the EBIT will be 1,000. Actually, this is 1 billion because it is in billions of dollars. And because after paying interest expenses, we have 900 as taxable income. And because the tax rate is 30%, the tax expense will be 270, and the net income will be 630. And in the equity financing, the equity has increased. Actually, it has doubled, $3.6 billion. So if you calculate the ROE, it will be 17%. However, if we rely on the debt by issuing bond and sell it, we can achieve the same EBIT but with different financing option. So we have to pay more interest expenses, which will reduce our taxable income. Therefore, the tax expenses will be lowered thanks to the interest tax shield from 270 to 243. And then net income will be this value, but equity remains the same. Therefore, ROE will be higher at 30%. So what we can get from this calculation is if as thing goes as we expected, then it is better to have debt financing because ROE is higher in that case. However, this is not the full story you can have. So by the way, the size of the interest tax shield can be calculated as the difference between these two payments, or you can calculate the same value as the bond you issued times the interest rate times your tax rate, and you can get the same result. And to understand the choices more in detail, we are going to conduct a sensitivity analysis. So we are going to think about alternative cases where the EBIT is not longer $1 billion, but it can be only $200 million, or it can exceed $1 billion and it can become $1.2 billion. So we are going to call the first condition as the bust condition, and we are going to call the second condition as the boom condition, following the economic meaning. So we can have an economical boom, or we can have an economical bust. And then these are the results. So the first two columns are the bust cases where we have an economic recession, and the next two columns are the boom conditions where we can have economic booms. And for each bust and boom cases, we have stock issues and bond issues cases. And as you can see, in the case of stock issue, the ROE is either 2% or 21%. However, in the bond issuance, you can have ROE of much lower one or much higher one. So therefore, we can say that the bond issues have more risk. You have more uncertainty when you rely on the debt financing. And it can be graphically shown like this. So on the right axis, you have EBIT, and this is the expectation you had before the analysis. Your EBIT will become $1 billion if your acquisition succeed. And in that case, you had if you rely on the equity financing, your ROE will become 70%, but it will be 30% if you rely on the debt financing. So by comparing these two, if you calculate this ratio, 30.5 over 17.3, it will be approximately 1.76 something. It will be approximately 1.76. So therefore, that's why this graph argues that there is a difference of 76% higher ROE with bonds. So this slope represents the case of the bond financing, whereas this slope represents the stock financing. So generally, you will have a higher return, higher ROE as the result with the bond financing. However, at the same time, you must aware that eventually your firm will be in difficulty because it will become lower at some point. So in the economic boom, you will have a better returns thanks to the bond. However, in the case of economic recession, you will suffer a lot because you will lose more due to the bond issues. At this point, we have found one benefit of that and one disadvantage of that. And we are going to elaborate it more, and we are going to think about the modern theories. And in modern theories, we have at least 5 factors to think about when we decide the capital structure. So this figure represents what we are going to talk about. And here you have interest tax shield as a benefit of that. And here you have a distress cost, which is another name of the bankruptcy risk, as a factor favoring equity than the debt. And the 3 other factors are the topics that I'm going to talk about. So we are going to learn about the market signaling, flexibility, and the management incentives. And in summary, there are 3 factors favoring debt financing. They are the interest tax shields, tax benefits, market signaling, and management incentives. So debt financing provides management incentives. And there are 2 factors that are against debt financing and that favor equity financing than the debt. They are the distress cost, which is the bankruptcy cost, bankruptcy risk we talked about. And the next one is the flexibility. And today, I'm going to talk about the market signaling. So, okay, I think I cannot complete the market signaling part, but let me just continue. So market signal, so in economics, we often have a situation called game. So this is similar to the video game or computer game you always think. And so in the game, there are multiple players or participants, and each of the player or the participants choose their own actions to achieve their goals or objectives. So each of them choose their best actions in response to others, and that is the similarity between the economic game and the computer game. So for example, in the League of Legends, maybe you are going to fight with your allies to compete with your opponents, and you want to beat the nexus of your opponent. And then you choose several moves, or you try to attack something, or you try to buy some items, and they are all the actions you choose to win the game. So in the computer game, generally your objective function is to win this game. But in reality, in this economic model, the game, generally the objective is to have the best outcomes or best returns from the game. And the game theory explains what will be their choices in the situation of the game. And when we think about a capital market, we often think about the information asymmetry as a main factor that makes it difficult to choose an appropriate action. So by information asymmetry, it means some people know better than the others. So for example, in the capital market, there are investors, the public investors like you, and the institutional investors like the hedge fund managers or bankers and other more skilled investors. But generally, the problem of the public investor is that they do not know precisely the economic situation. So often your returns will be lower than the institutional investors. So that's the problem. And we want to find how can we resolve this issue. And in this case, we are going to think about an asymmetric information, but we are going to focus on two players. We have investors and we have firms or companies. So in the capital market, firms or companies want to raise funds from the investors. And by doing so, they can invest to valuable projects to earn the future returns. But at the same time, investors try to invest or choose on adequate firms for their investments, and by doing so, they will be able to get future returns. But the problem for the investors is that sometimes some firms are very good, so you may get a lot of returns by investing in the firm, but other firms are usually not that good, so they are mediocre or they are even bad, so maybe you will lose your money by investing in the firm. So that's the problem. And the investors' information asymmetry is that investors do not know firm very well. However, firms know their financial status and their future performance better than the investors. So we have an information asymmetry. And then investor needs to make good choices. In other words, they have to find good firms to invest, and maybe that they can get some hint from the actions of the firms. So the firm's choices can sometimes become a signal to the investors. And we can get a clue about the status or the financial performance of the firm by looking at their financing choices, whether they rely on equity financing or whether they rely on the debt financing. And to overview, that equity financing is not preferred because equity financing can be a signal that the firm is not that good, the firm is bad. So equity financing is a bad signal, and that's why firms often rely on the debt rather than raising more capital by issuing new shares.